Most people who lose money in the stock market are not stupid. They are not unlucky. They simply skipped the most important concept in all of investing, a concept so powerful that Warren Buffett called it the 3 most important words he ever learned today. I'm going to explain it so clearly that you will never forget it. My name is Benjamin Graham. I wrote The Intelligent Investor in 1949, and the one idea that changed everything for every serious investor who came after me is this: the margin of safety. Let me show you exactly what it means, the bridge that changed how I think about money. Imagine you are an engineer, and your job is to build a bridge over a river. You calculate that the heaviest truck that will ever cross that bridge weighs 10,000 pounds. Do you build a bridge that holds exactly 10,000 pounds? Of course you do not. You build a bridge that holds 30,000 pounds. You build in a massive buffer, a cushion, a protection zone between what you expect and what could actually happen. Because you understand something very important. You could be wrong. Your measurements could be slightly off. The materials could be weaker than the supplier. Said an unexpected storm could hit a heavier vehicle than you anticipated, could roll across that bridge one day. The extra 20,000 pounds of strength you built into that bridge, that buffer, between your calculation and reality, that is the margin of safety, and the investor who ignores it is building a bridge that collapses the moment anything in the world goes slightly differently than expected. How this works with real money. Here is how the margin of safety works when you are buying stocks. Let us say you study a company very carefully. You read its financials. You understand its business. You calculate that this company is genuinely worth $100 per share. The question is, what price do you pay for it? Most beginners hear the company is worth $100, and they immediately think, great, I will buy it at 95. I am already getting a small discount. Wrong. That is not a margin of safety. That is gambling with almost no protection. Here is what I taught Warren Buffett and every serious investor who ever studied under me. If the business is worth $100, you do not buy it until the price drops to $65 or $70 maximum. That $30 to $35 gap between what it is worth and what you are paying, that is your margin of safety. And here is why that gap is everything. You will be wrong sometimes, and that is fine. I want you to hear something that most financial content will never tell you. You will make mistakes. I made mistakes. Warren Buffett makes mistakes. The greatest investors who have ever lived make mistakes. The future is genuinely uncertain. Companies face unexpected problems. Industries change. Governments change the global economy. Throw surprises at us constantly. The margin of safety does not assume you will be right every time. It protects you for the times you are wrong. Think about it this way. If you believe a stock is worth $100 and you pay $100 for it, and you turn out to be wrong, and it is actually only worth $70, you have just lost 30% of your money immediately. But if you paid $65 for that same stock, and it turns out you were wrong, and it is only worth $70, you have still made a small profit even though your analysis was off the margin of safety. Turns your mistakes into survivable events instead of catastrophic ones. That is not a small thing. That is everything. Why beginners skip this and pay the price. In 2026, the temptation to skip the margin of safety has never been stronger. You open any social media platform, and someone is screaming about a stock that has already doubled, and they are telling you to get in now before it goes higher. You see everyone around you apparently making money, and you feel the panic of missing out. And so you buy at whatever price the stock is currently trading. You pay full price, or sometimes more than full price, for something, and you tell yourself the story that justifies it. This is exactly what happened to investors. Before every major crash in history, they convinced themselves that the price they were paying was reasonable. They had no margin of safety, and the moment reality arrived, and reality always arrives, the losses were not 30%. The losses were 60, 70, 80%, and those losses took years to recover from the margin of safety. It is not pessimism, it is not fear, it is not a strategy for people who lack confidence. It is the single most rational thing an investor can do. It is what separates the investor from the speculator. The one question that changes everything before you buy any stock, any investment, any asset of any kind. I want you to ask yourself one question. What happens if I am wrong? Not what happens if everything goes right. Not what happens if the story plays out exactly as I expect. But what happens if I am wrong about this? If your honest answer is, I lose everything, or I lose so much that it takes me years to recover, then you have no margin of safety, and you should not make that investment at any price. If your honest answer is, even if my analysis is off by 20 or 30%, I still come out. Okay, then you have built yourself a margin of safety, and you can proceed with confidence that one question practiced consistently will protect you from more financial disaster than any stock-picking system, any trading algorithm, or any financial influencer on the internet ever could. The bottom line, the margin of safety, is not complicated. Find something worth $100, pay $65 build in a cushion, for the inevitable fact that you will sometimes be wrong. Never put yourself in a position where a single mistake destroys you. This principle kept me rational through the Great Depression, through 2 world wars, through every market panic and bubble of the 20th century, and it will keep you rational through whatever the 2020s decide to throw at your portfolio. Invest in what you understand. Pay less than it is worth, and always, always, leave yourself room to be wrong. That is the margin of safety. That is how the intelligent investor thinks. Thank you.